So, hello, welcome to the Chambers Financial Services podcast. I am Sam Bailey. I'm the head of marketing at Chambers Financial Services. And with me today is
Tony Baker. I'm the proprietor of Chambers Financial Services, and I'm looking forward to discussing the current climate of mortgages with you.
Yeah, so the reason why we've got together to record this podcast today, obviously there's been massive changes for everyone over the last couple of weeks with coronavirus starting to have a real impact on our day-to-day lives. As you can see, we're both recording this from home because all of the government advice is sort of work at home if you can. So that's why you're sort of seeing the settings that we're in at the moment. There's been lots of changes over the last couple of weeks, and I'm just going to ask Tony some questions about that. Hopefully we'll be able to address a few things and just like see where the conversation takes us. So, Tony, it's been a strange couple of weeks for mortgages.
I think it's been a strange couple of weeks for mortgages, but also a strange couple of weeks for life in general. It's unbelievable that the way that effectively our liberty has been curtailed in so much as we're not being able to go out and we're not able to do the things that we would once take for granted. I popped to the shops to get some urgent food yesterday, and it just felt really strange and eerie, almost like it was Christmas Day with just literally nobody about, and it was very, very strange. But ultimately, my main concern is the health for our clients, our staff, our families, because that comes first, because at the end of the day, none of this matters unless we've all got our health. So that's our top priority at the minute, and we just have to accept and work within the legislation that's laid out, because it's for all of our benefit after all.
Without doubt.
But I mean, really, in terms of changes, I guess that it's really this week, it's really sort of changed for all concerned. We decided to shut our doors on Monday. That was before the lockdown was announced on Monday evening, because we felt that we couldn't properly socially distance ourselves within the office environment. And again, my main concern was for the health of our staff. But we kind of planned a couple of weeks beforehand that we could work from home and we could operate the business remotely. So that's what we've been doing over the last few days. Mortgage-wise, really the main changes kicked in from Tuesday, really, because with us going into the lockdown situation, it's kind of really put the cat amongst the pigeons, really. First of all, because we are only allowed to go out for essential work is only to be carried out outside of the home, physical mortgage valuations have ceased to take place from Tuesday onwards. So, as you know, when a lender lends money to on a property, a physical valuation typically needs to take place, and obviously that stops from now on until obviously we get back to some normality. So that was the first big change. The secondly is that because of the environment and because that we are being advised to, or in fact told to work from home, a lot of the lenders are just simply unable to process the levels of business that they've got right now. So what's happened is that they're operating on a skeletal staff. They're operating from home. The offices are not open anymore. Plus, on top of that, you've got the situation where the Chancellor announced the 3-month repayment holiday for mortgages. So lenders are being inundated with requests for those for 3 months holiday. So not only are there got to be a resource for taking those calls in the first place, but also to be then in a position to process the request at that time. So what's happened is that new business has really slowed down, and as a result of that, banks have withdrawn a lot of their products that we would have typically administered. So the other thing as well is because of the lockdown scenario, the government's advice on people buying houses is that if you've exchanged contracts, they're trying to extend completion dates. Where that's not possible, because sometimes for various reasons it can't be possible, is to only move if it's safe to be able to do so. But if ever you've tried moving a house, I'm sure you can appreciate that social distancing is going to be very, very difficult to be able to do that. So
yeah,
really moving is being pretty much put on hold at the moment, unless there's very good reason not to, or there's an emergency requirement to actually move in quickly.
So just to pick up on a couple of things that you said there, I want to come back to you in just a second with regards to the products that are getting pulled. But you've also sort of spoken about how with lenders working with a skeleton staff, but with increased inquiries, that is significantly slowing down and impacting new business coming through. Can you see a point at the moment where that will be addressed by lenders and they're likely to be able to get back to or at least improve their level of service?
Yeah, I mean, at the moment, obviously, we just don't know how long we're going to be operating under the auspices we are at the moment, i.e. the lockdown. We just don't know how long this is going to be, or how long the impasse is going to be. So I think there's going to be an element of disruption for some while until that we're able to get back to normality. I think that things will get easier as time goes by, because I think that at the moment, getting through to the bank, I tried calling a bank today on a personal level, and getting through is just absolutely impossible at the moment. Branches are closing. So I think once the initial kind of surge of requests for 3-month payment holidays curtails a little bit, and things kind of ease down a little bit in, say, maybe a couple of weeks' time, then I think that the banks could maybe operate and open up the doors a little bit for further business at that time.
So then that brings us quite neatly on to what you were saying around banks pulling particular products. Is there any indication as to which or what type of products they are pulling back on at the moment?
Yeah, very much so. Yeah, it's at the moment, this is not all lenders, by the way, but and many lenders are still looking at how they're administering business at the minute, because, as you can imagine, whilst it's not come as a major surprise, it's still very it's the level of pace of changes has been very, very quick at the minute. So what we're finding is that typically where lenders have slowed down or stopped the business completely is in the higher loan to value products. So if your mortgage is, if you're buying a property and the loan to value is at the higher end, then basically those products are becoming fewer as we go on. For example, Barclays was the first mainstream lender to really reduce their product range. So they're no longer at the moment accepting any applications with a loan to value above 60%. The Lloyds Banking Group has followed suit thereafter, and some other lenders, Santander, announced today that they won't accept applications for loan to values above 75%. So a lot of this is going on, and it's literally changing minute by minute, hour by hour, and day by day. So just going back to the physical valuation side, is that lenders will tend to want to value property in a physical sense, where you're borrowing a higher amount against the value of your property, because they want to make sure that that valuation is realistic.
Mm.
What they are doing, and more and more now, and obviously I think with this change it's exacerbated it, is doing more desktop valuations. So every bank would have a value to each property, typically based on the sale price that's taken place before, and indexed accordingly. So they can kind of get an indication of where a value of a property could be. So rather than having a physical valuation, they would use their indexation valuation, but typically that's only available on the lower loan to value side of things, hence why they've cut a lot of the higher loan to value products out, so that they can manage their workflows, but also be able to fulfill the application through to offer. One lender that I'd submitted an application to yesterday came back to me this morning and cancelled down the application completely, because they were unable to go through to getting a physical valuation in order to getting that complete, and that was on a buy-to-let basis. So the buy-to-let market has very much taken the buy-to-let market is kind of very slowed on that basis, because typically banks want to get a physical valuation done on a buy-to-let property to ensure that it's worth what it's worth, get an appraisal with regards to the rental income that's derived from that property, and also to make sure that it's in a habitable and lettable condition, because ultimately that's going to be the source of repayment on a buy-to-let mortgage. One lender yesterday, what I thought was very, very proactive, basically said that rather than doing a physical valuation, which obviously can't be done at this moment in time, they've adjusted their practices to be able to do an automated valuation on houses up to 75% loan to value and flats up to 50% loan to value. So again, there is options available for people. So we can accept business, but it's just going to be pretty challenging, and we may just have to just take my recommendations based on a number of extra factors that never came into it, which includes processing and basically getting deals over the line.
Are there any particular groupings of people that are going to be more affected by the shift towards desktop valuations? Obviously, you mentioned the buy-to-let market. I would also imagine that based on this discussion that we've had around sort of the banks that are cancelling down or removing products where there's a higher loan to value ratio, that would probably affect people that are sort of first time buyers or have bought recently and remortgaging.
Yeah, I think in a nutshell, first of all, purchases are going to be people that are purchasing property are going to have some sort of level of difficulty, just purely from the fact that a physical valuation may need to take place, especially if you're staking that property is going to be lower. So that's one group of clients that are going to be affected. You've then got people that are remortgaging. So you're coming to the end of your fixed rate period or your product period, and those people seeking to get a new deal may be affected as well. The good thing about remortgaging is that typically lenders will do an automated valuation. So those people that are remortgaging on the higher side could be affected as well. Okay. And landlords that are looking to either acquire buy-to-let property or remortgaging buy-to-let property will be affected also, with a lot of lenders pulling out, which will leave only some lenders that will be able to administer those applications at the moment.
So for people that are in that situation, what can they be doing? What is the best solution for them?
I think with people purchasing, I think at the moment the government advice is to just basically put things on hold for the moment, because at the minute the whole supply chain is affected in terms of, you've got solicitors that are working on very skeletal staff as well. They're working from home. A lot of solicitors are pulling out the market. Estate agents are struggling at the moment. So I think at the moment, if you're purchasing a property, unless you're really further down the line, then you may have to put your plans just temporarily on hold until everything gets back to normal. If you're remortgaging, what banks are able to do would be to potentially offer you a new rate. So we can keep the mortgage with the existing lender, but just offer a new rate for them. So we can literally do a product transfer. So we can literally move the mortgage from one product to another at a given time. That's the easiest way, because there's no solicitors involved, there's no underwriting involved, and that particular lender would typically have a valuation of your property based from the indexation that's taken place from when they first administered the mortgage, and the valuation was carried out at that time. So basically, no one should feel like they're going to have to need to go onto the lender standard variable rate. That can be avoided, but again, it's just reviewing that situation. Where you're going to have an issue potentially is that some lenders are not allowing you to transfer your products whilst you're on a 3-month repayment holiday. So again, that's another aspect that's got to be factored into all this as well. So it's a whole melting pot at the moment, as you can imagine. So everything's going to have to be done really to the minute detail. Where people are looking to borrow further money, so if you're looking to do some home improvements, or you're looking to do some debt consolidation, or you want to just capital raise for one reason or another, then again, it would just have to be reviewed with, will that request be within the parameters of remortgaging it to a new lender, or will you be able to take a further advance out with your existing lender? And again, does it fit the parameters that we're working to? So again, those people we just have to have a conversation with to decide what's best for them on that basis. So again, they could be affected. And landlords, again, if you're coming to the end of your deal, then you should be offered a new product by your current lender. So we can simply do a product switch from one to the other. If you're looking to move to get a better deal, or relinquish some extra cash to make some further acquisitions, that's going to be difficult, because on the buy-to-lets, the physical valuations are more prevalent, so it might be more difficult to move mortgage from one lender to another on that basis. So again, we just have to look at see where we are, what we're looking to achieve, and to see whether it's possible to achieve that, or whether it might be better to just place things on hold and see how things go. I think it's better to kind of look at your options earlier on. So the earlier we can look at this, we can then plan a course of action. Lenders will switch products typically 3 to 4 months beforehand. So if you're not looking to borrow any further funds, and the rate that's been offered is very competitive, then that may be the best course of action. But every single situation will be dealt with by us and your broker on a case-by-case basis, because they'll be looking at what is the need in hand and how best is to fulfill that need for our clients.
So for those people that are on standard variable rates, well, basically taking this back to sort of the first inklings that we both had that this whole coronavirus outbreak was going to be really significant, was that initial drop of the Bank of England rate from 0.75% down to the 0.25.
Yeah.
Has that started to have an impact on those those types of mortgages?
Yeah, I mean, the first reduction from 0.75 to 0.25 just really came out of the blue, and that's kind of really where I felt, first of all, this may be more serious than what we had initially anticipated, because from especially economically, because that was a major jump, and it was like completely out of kilter with any meetings that were scheduled to take place, etc. And then obviously since then we've had a further reduction, when obviously this has all been going into full swing, to a reduction to 0.1%.
Mm.
So in answer to your question, that rate has, if you've got a tracker rate that's directly linked with the Bank of England base rate, then you'll probably find that your mortgage payments will go down, because it's intrinsically linked. It'll be a certain percentage above that base rate. So there are some flaws within the contract. So what it will state is that typically, if the Bank of England goes to, say, 0%, then you'll find that there will be a flaw, so that your rate can't go below a certain level. But typically, people are finding that, that if you're on the tracker rate, that payments would have gone down. On the other hand, standard variable rates, some lenders some have and some haven't reduced their standard variable rate, so they've passed on their variable rate that's come down in line with the Bank of England base rate. So if you're on the standard variable rate, then again you would have probably seen, or will start to see, a reduction in your mortgage payment as a result of that. However, what we're finding though is that even though you are on a standard variable rate, the bonus of being on a standard variable rate is the fact that you can move your mortgage or sell your property, and you've not got any early repayment charges. So if you're in a sort of a position where you're looking to potentially move within a short period of time, then obviously it's the fact you've had you're going to get your monthly mortgage payments reduced is a good thing. But ultimately, the standard variable rate is a much higher rate than what you can get if you was to fix your rate or take out a new tracker mortgage. So so if you are on the standard variable rate and you've got no plans to move, whilst it's great your mortgage payments come down, they should come down much further. If you're mortgageable, so you can prove affordability, then you should be talking to your broker about reducing your monthly mortgage repayments, because there's a hell of a lot of people that are on standard variable rates out there, and I'm pretty sure that in many cases people can get a much better deal with their mortgage to fixing at low rates. One thing that hasn't really changed an awful lot is fixed rates at the moment. I think that there's two reasons for that. I think one is that the fixed rates are really low. I mean, I'm just arranging a mortgage at the moment for clients that are looking for a 5-year fixed rate at 1.44%. That's a 5-year fixed rate. You can get a 2-year rate for 1.19%. And when you're thinking that standard variable rates are typically sort of 3.25% upwards, that's a massive difference to mortgage payments. So you should really focus on and review your payments if you're review your mortgage arrangements if you're on a standard variable rate, even though it would have come down.
With regards to the fixed rate and its relation to the Bank of England base rate, can you see them coming down in the near future? Or I mean, obviously none of us got a crystal ball, but does it seem like that they are as low as we're likely to see them at this moment in time?
You're right with the crystal ball scenario. We just don't know. I mean, no one saw the base rate coming down to where it was, and no one could see this pandemic that we're in at the moment, you know. So we're living in really uncharted waters at the minute. I think that I don't see rates coming down in a hurry, that's for sure. I think that the problem you've got is where lenders have got pressures on processing. One of the ways in which lenders do tend to manage their pipeline and manage the applications that come in is their rates. So the one thing that would be, if banks are struggling to process the levels of business they've got at the moment, the last thing they're going to do is reduce rates to have an influx of further applications. So my personal opinion would be, as I don't see fixed rates coming down in the short term. I can see some of them going up to basically where lenders are trying not to take on as many applications. If they're swamped with applications at the moment, they'll potentially put rates up just to stem the tide for a period of time. So I can see rates being pretty stagnant for the foreseeable future. And I just hope that when normality does ensue, that the higher loan to value products will come back on the shelves and be able to people will be able to work as they did beforehand. But again, that's really my view, and we just don't know what's going to happen in the near future, because it's changing hour by hour at the moment.
Of course, and it does seem to be changing sort of like hour by hour, as you say. So just on a last point on mortgages, before I know we want to talk a little bit around insurances as well. What are your key takeaways for people that they should really be aware of and sort of focusing on with regards to the mortgage and their property at this unprecedented time?
First of all, stay safe, stay within your parameters, and abide by sort of government direction on health. That's the most important thing, I would say. In regards to mortgages, if you're looking to get the 3-month repayment holiday, banks are being very, very helpful and being very they're bending over backwards to help their clients in a difficult time, which is something that in the past you could argue that may not have always been the case. So if you do want a 3-month repayment holiday, banks will help you. All you need to do is contact your lender directly. So if you go onto your lender's website, they will have either a phone number to call or a process either by an email or a portal to enter details in to be able to get that 3-month repayment holiday. So there's a few caveats that I would like to say about the 3-month payment holiday. One is that your credit file should not be impaired. So anyone that's concerned about that, providing you've made arrangements with the lender that you want your 3-month payment holiday, then your credit file should not be impaired. If you cancel your direct debit and you don't tell the lender, then you will be impaired. So don't, under no circumstances, do that, because ultimately you'll then get a default and arrears, which will affect your credit file. So whatever you do, if you want that 3-month payment holiday, ask the question, okay, because that's really, really important. The ramifications of that is that whilst you won't get an impairment on your credit file, you will be charged interest. So interest will continue to be charged on the borrowing. So typically what will happen is that once you then go back to making payments, the repayments will be typically recalculated to levels that will catch up with those interest, those capitals that are missed, because interest would have been charged and obviously no deductions would have been made. I alluded to earlier that some lenders are not allowing people to transfer products whilst they're in the 3-month holiday payment period. Whether that will change, I don't know, but that's another cause of concern. So if you're coming to the end of your product period, then again, exercise a little bit of caution within that. And I would just say you're going to have to, there's going to be a catch-up point at some point, but if you really are struggling from a cash flow point of view, then do make the call, because ultimately, I don't know how long this is going to go on for, and having money in your bank account could be the best way for you to be able to cope with this situation for the next period of time.
I think all of that is great advice, and will probably be really well received by people if they are happen to be struggling at the moment, and a lot of people are.
But talk to your broker, because ultimately we've got a finger on the pulse. So we're looking at the market in general is changing like there's never been before. Criteria is changing like never before. we're the ones that are in touch with lenders and asking the questions and probing what's going on all of the time. So any matters relating to mortgage advice, do have conversations, do call your broker. We're here to help. We want to help our clients. It's for the better. Whilst we might not be able to do anything physically at the moment with the market, we can certainly look to have good conversations, provide the advice that we can, and maybe help plan for future events that are coming up, and ensuring that people can be in the best position for when they want to make those plans a reality, whether it be 3, 6 months or years time even. But do have conversations. We want to talk to our clients. We want to answer questions. We want to be there. As a point of contact, and no good broker should shy away from that.
So turning now to insurances, obviously mortgage market has been massively affected by this. Have we seen the same impact on things like life insurance, for example?
Not in as far as criteria. We have found that a lot of companies are slowing down their are not being able to process their a lot of it's automated. So when you go in to apply for a life insurance policy, or whenever I do so on someone's behalf, it's very, very automated in the way lifestyle medical questions are asked, and providing that you meet criteria based on those questions, then the cover can start, and there's an automated process. The difficulty we're going to find is where people, if there's a question on health that needs to be bottomed out, because if you have a health condition, then what sometimes typically can happen is that the provider will request like a GP report to underwrite the policy. So again, you can imagine, obviously, that sometimes it's not open at the moment for various reasons. They're going to be impacted on health concerns at the moment with this is obviously a health issue that's going on at the moment. So you may find that getting a policy up and running may be delayed on that basis. So, so if you're getting a life insurance policy, even outside of this particular crisis, do get the process underway as soon as possible, because if further investigations and various questions are being asked, that's going to take some time to bottom out normally. But even in a situation like this, then getting a policy in place may take a little bit longer.
Question on with regards to income protection. Obviously, there's been a lot of stuff happening over the last week with regards to the government trying to protect businesses, and support measures coming out in the last day or so with regards to protecting those who are self-employed. Would something like income protection cover individuals over the coronavirus outbreak? I appreciate that would probably differ policy to policy.
Yeah, it's broad brush. I mean, I think some of the things that you've been alluding to may be down to unemployment, where people have been furloughed, which is a completely phrase I'd never heard of apart from in the last week or so. So if you've been made unemployed or furloughed, income protection won't cover you. Income protection will cover you for health reasons. So if you've been signed off by your GP that you're unable to work, that's when income protection will cover you. What you'll typically find is that most income protection policies have a deferment period, so you would have to be off for a period of time before you can claim. What we're seeing is with the coronavirus in where it's a milder claim or milder situation, symptoms generally tend to be come and go within a 2-week period. So therefore, you would not claim on an income protection policy at that point. Obviously, if there was an underlying condition and you were off and been unable to work for a longer period of time, then you may need to be able to claim on your policy if a doctor signs you off and you've been off for that deferred period of time that was specified in the policy that was set up on the outset.
And just a final question on insurances. With the coronavirus outbreak, are we seeing any sort of policies and conditions coming into force that are basically protecting insurers against sort of paying out with regards to coronavirus?
It's really early to say, but basically, you won't be covered for coronavirus under a critical illness policy, because a critical illness policy or a serious illness policy basically means that you can claim once you've been diagnosed with a specific condition to a certain severity. Now, no critical illness policy, as far as I know, would have a specific coronavirus clause in that contract. So I think if you've got coronavirus, then you won't be able to claim on it as far as critical illness is concerned. In death, sure. Basically, if someone experiences death, then their surviving partner or beneficiary could make a claim on that basis. Because ultimately someone has died and it's very much black and white. You've either died or you're not. So on death, then you can claim on your life insurance policy on that basis. So yeah, that's kind of where current coronavirus does impact on insurances.
So as a sort of like final takeaway on insurances, doesn't seem to be having as big an impact in the insurance market as it has had in the mortgage market, but it is still critical that if you're sort of going down an insurance application route, that you plan in that extra time.
Yeah, I mean, yeah. Whenever I talk about mortgages anyway, it's always best to get the once we've established that a life insurance policy is required and the recommendation is made and a client wishes to proceed on that basis, it's always best to try and get the application in underway anyway, because we don't know. Unless we ask the questions, we don't know someone's medical background, and nor should we at that point. We will ask if they're in good health as a general rule to kind of get some sort of idea. But when you actually get into the in-depth questioning of completing the application form process, that's when we kind of get an idea as to what will happen. Sometimes insurers will want to get a GP report if the level of cover is high in comparison to their age. So if you're an older person that wants a lot of cover, they may want to check a GP report to make sure there's no underlying conditions, because ultimately they're accepting that risk. If there's any previous medical conditions, they may want a GP report, or it may well be as well that sometimes lenders will want to undertake a medical of that person. It's all at their cost. But again, if you're going to undertake a medical, then someone's going to have to come out to see you to undertake that medical. And therefore, again, that's going to be prohibitive under the current rules of coronavirus with regards to social distancing, etc., etc. So absolutely right. If you want some life insurance and a recommendation is made, then absolutely start the application process as soon as possible, because it's always, whenever we talk about providing mortgages, insurances, etc., the mortgage is always the most immediate need, because that's what triggers the conversation about the other things we discuss. And everyone wants a mortgage straight away, because ultimately that's going to determine whether someone moves or not. And so it's very easy to then put off the life insurance for further down the line, because there's no compulsory requirements for you to have life insurance when you're arranging a mortgage. So that can get left behind, and it's really important that it doesn't, because we would not want to see someone either die or suffer a critical illness or a long period of absence due to illness and not being able to claim. But ultimately, you know, it doesn't always happen overnight that you can apply for a policy on day one and be in a position to be covered at that point. It can do, but it's not always the case. So like anything, we always suggest you need to plan for your mortgage, plan to be in a position to be able to be in the best position to present the best case to lenders. And it's no different with life insurance in so much as even if like you don't require the policy for until a mortgage completes in maybe a month or 2 or 3 months time, we can get the agreement. Even if it gets agreed straight away, it doesn't mean you have to start the policy straight away. The policy can start from the exchange of contracts or at a specified date in the future. So having that policy ready to go at that point is really important to do so. So planning for everything has never been more important as what it is at the moment.
Fantastic. So just as a final point, final takeaways for people, and can you tell people how they can get in touch with us as well?
Yeah, well, I think first of all is seek professional advice at all times. So call your broker. Obviously, to call us, do visit our website, which is chambersfs.co.uk. Do contact us via email, which is info@chambersfs.co.uk, and our telephone number is 01268 744 333.
Fantastic. So that's that kind of wraps up our update today on the coronavirus outbreak, how it's been affecting the mortgage and insurances markets. Obviously, we are trying to keep abreast of the situation as best as we can. If there are updates in the coming days and weeks, and we anticipate that there will be updates in the coming days and weeks, Tony's obviously told you about our website where you can keep abreast of information. You can also visit our Facebook page, which is facebook.com/chambersfs, where we're also posting updates as well. And we'll probably be back with one of these very soon, I would imagine.
Absolutely, yeah. I mean, we want to kind of provide as much information as we can to add value to our clients and anybody in general. We want to be able to help people. So we'll be looking to do some further podcasts, videos, social media posts, etc., to provide as much information as possible to everyone as the elements to the markets change on a continuous basis.
So that's it from Tony and myself for now. All that's left to say is stay safe, stay home, and wash your hands.
Absolutely. Thanks, Sam.